Yes, yes, yes. What an incredible week of trading we had this last week. Um, there's some interesting changes that happened last week, and the volatility picked up dramatically. Now, the problem that we have is that volatility can either help you or hurt you. And the problem that I found is that most traders do not have a way or a system that's incorporated into their daily routine to track whether or not the volatility is impacting their trading. So let me just give you an idea of what's happened here. Is that if you look at the last 2 weeks prior to, let's say, Monday, the last 5 days is over here, and the last 2 weeks prior to that. If you're using a 10-minute chart, now you can use a 30-minute chart, a daily, whatever you need to use to have a way of tracking the volatility so that you can make the appropriate adjustments when you start to notice these changes taking place. So what happened is that if you looked at the volatility in the last 2 weeks prior to that, and let's assume you're in a 10-minute chart, you would have seen that it's mostly hanging around at, the 3 level there in that ATR kind of concept. So, but what happened in the last 5 days is you will see that the volatility shot up. Now, the volatility is your friend provided you are aware that it's actually happening. So the problem that I've seen is that everybody's got things on their chart for momentum, for price, a moving average crossover, the this, the that. But I have very rarely found a trader that has the volatility incorporated into their daily routine, into their daily thinking. So it's something that you must have. So what's the solution? Okay? You should have one chart, at least one chart, that you have with you have the ATR on it so that you are aware of the changes. The problem is that most people are not aware of the changes. Consequently, you start hearing all the whining. Oh, man, I got stopped out. Oh, I got stopped out. I got stopped out. I don't understand this. And then it went in the same direction. The story is the same. If you talk to people over and over, they say, boy, I got stopped out, and then it went in the direction that I thought it was going to go into. So the problem isn't that you didn't get the analysis right, the direction right, your entry right, none of those things. Those things happen. The problem was that you were not aware of the impact of volatility on your trading. So how do you make that adjustment? The first thing you got to do is you have to widen your stops, or don't take the trade, because when you've got that kind of volatility going, what's happening is that if you had a normal 6-tick stop, let's say, and I'm not telling you to have a 6-tick stop, let's assume you can have an 8-tick stop, you can have a 9-tick stop as your normal trading, but understand whatever your normal size of stop is, whether it's 6 ticks, 7 ticks, 8 ticks, 9 ticks, whatever the case is on the ESE Mini, whatever the case is, you need to know that you're using that level of stop for an implied volatility of this amount, whatever this amount is. Now, you may not be saying that on purpose, but the reality is that that's what you're doing. So when you notice a change like this, you must also change how you are positioning your money management piece, because now it becomes not only an entry game, and it's always been a money management game, but the money management piece becomes more important when you have volatility. So in these kinds of markets with low volatility, you may have to set lower targets, and you can get away with smaller stops. So, but when you are in a period of extreme volatility or much higher volatility, now you can actually widen your targets, but you also must widen your stops. So now if you don't have the bank account, the futures account, to handle the widened stop, reduce the size of the number of contracts that you're trading during periods of high volatility. So that's one way to make the adjustment, is reduce the number of contracts you're trading, and then also increase widen the stop so that your money management piece is not hit, so that your account is not taking a devastating loss because of this increase of high volatility. This increase of high volatility, if you're not aware of it or not paying attention to it, can wipe out 1-2 weeks of gains if you are not paying attention. If you're using small targets down here, and then all of a sudden you get hit for, a couple, 3 stops, you can wipe out all the gains that you got the prior week or two. So you have to have this kind of scenario incorporated into your daily routine so that you can take advantage of volatility when it increases, and you take advantage of volatility by having increased target size, and you must also increase your stop at the same time. So you've got to do, you don't have to do both. You definitely have to do the widen the stops, but you also at the same time can get bigger targets. So you've got to balance that in your thinking and your way of trading. Now, stop whining when you get stopped out. You get everybody stop whining. The solution is right there in front of you. You've got to pay attention to what you're doing. This is not a game for the faint of heart. This is the best business in the world. It's the best money management game in the world, provided you pay attention to what you're doing. If you think you're so great, if you try to play Tiger Woods in golf, you're not going to beat him. If you think you can beat him in even just a 9 round of golf, not even say 18. 18, you don't even have a chance. But let's assume you're a good player, and you're 9 rounds of golf, 9 rounds. The only way for you to beat a professional like Tiger Woods or Phil Mickelson or Ernie Els, any of these great players, is they're going to have to be on their worst day, and you're going to have to be on your absolute best day, and for a short period of time, let's say, like I said, 9 holes. And you probably ain't even going to do that, beat them. But now, you can't expect to come into the game where you've got the brightest minds in the world on Wall Street, you've got deep pockets. You can't expect to beat those people at their game. So you've got to figure out how to play within that game, based on what your skills are, based on your knowledge, based on your own work ethic, your thinking abilities, your mental abilities. So you've got to take responsibility, 100% responsibility, not 50%, not 75%. Don't blame your mentor, your trainer, whatever. You have got to take responsibility for your trading and understand that you better account for some kind of volatility in that, or else you are going to suffer. It's your bank account. So nobody has a better interest in your bank account than you. So make sure that you incorporate something like this. A lot of people don't even know. There was about 3.3 million contracts traded on the E-mini contract on Friday. Now, that may surprise some of you. You may say, what, 3.3? You don't even know how many contracts are normally traded during a normal trading day. The next thing is that, did you know that was like the highest daily volume for E-mini contract in over a year? I mean, you got to expect some changes. That kind of momentum, impact, especially, is going to make this thing go, wow, why? Just like it's been going. But you have got to take the responsibility for becoming good, okay? Stay mentally tough. If you had your 6-tick stock when the ATR was 3, double it to 12 so that you can make the appropriate changes. Stay mentally tough, use common sense, and take 100% responsibility, and let's get ready for next week's trading. Thank you.